Hi, and thank you for joining us as we continue our discussion aimed at demystifying what tax governance means for your business. My name is Louis Carney. I'm an indirect tax specialist here at RSM in Brisbane. I'm joined by Michael Killeneva, a specialist from our corporate tax division. Now, throughout our first 5 episodes, we have discussed tax governance from a more holistic perspective, covering justified trust, the ATO's review programs, what the ratings mean to your business, and the relevant guidance published by the ATO. Over the next few episodes, we will cover the 7 principles of effective tax governance in more detail, with this segment focusing on Principle 2, identifying tax issues and risks. Mike, do you want to give us a brief overview of this principle?
Thanks, Louis. The ATO want to see that taxpayers have put their mind to how tax risks are identified and managed within their businesses. This is usually evidenced by a process or procedure that assists taxpayers in identifying issues that have the potential to turn to more significant tax risks in the future. Broadly, the ATO want to see that tax considerations are being included in management's decision-making processes, that management are aware of the consequences that may arise from the issues identified, material transactions are well documented and subject to appropriate review and sign-off for tax risk management purposes, and that where tax issues are identified, that processes are in place to manage the issue to limit the impact on the business. This may include obtaining certainty from the ATO directly. It's important to note that processes developed to identify tax risks are not limited to income tax, but also include FBT returns, activity statements, withholding taxes, and BAS lodgements. Louis, what would these procedures and processes actually look like for your business?
Well, Mike, where these tax lodgements are dealt with internally, the ATO expect to see controls to identify tax risks in end-to-end procedures covering things like initial data extraction processes to identify the correct tax treatments are applied to material, ongoing and atypical transactions, consideration of ATO guidance relating to material transactions, how personnel are to prepare the tax reconciliation calculations and guidance on how they are linked to the tax return disclosure items, referencing and reconciliations between financial statements, work papers and source documents, separation of duties in the preparation and review process. Now, where taxpayers are using external advisors to prepare the tax lodgements, the ATO will still want to see things like effective controls are being undertaken to ensure the accuracy of the data and information provided to external tax agents. Taxpayers review the deliverables, such as management letters, returns, work papers, and forms to ensure they are consistent with the agreed scope of work. Any tax risk identified by external advisors are considered and actioned by taxpayers. The ATO take a don't tell me, show me approach throughout their reviews. So it's essential that the key processes are documented to ensure objective evidence can be provided to the ATO in the event of a review.
To add to your point around tax management letters from external tax advisors, these letters vary between advisors. However, most of them will identify several issues that generally get put to the side or forgotten about once the relevant lodgement's completed. So ideally, management will discuss the issues identified in these letters in detail subsequent to the lodgement of the return and start thinking about how to address these issues depending on the significance of the risks identified.
Thanks, Mike. In the next episode, we will cover Principle 3, seeking advice.
Thank you. We'll see you next time.
Thank you. Bye-bye.